This is The Corner Series, a McGuireWoods series exploring business and legal issues prevalent in today's private equity industry. Tune in with McGuireWoods partner Geoff Cockrell as he and specialists share real-world insight to help enhance your knowledge.
Thank you for joining another episode of The Corner Series. I'm your host, Geoff Cockrell, a partner at McGuireWoods. Here at The Corner Series, we try to bring together deal makers and thought leaders at the intersection of healthcare and private equity. Today, I'm thrilled to be joined by Max Reiboldt. Max is the chairman at the Cockrell Group, one of the premier sell-side investment banks in healthcare transactions. Max is also the author of a super interesting book, Private Equity in Healthcare: Leadership, Economics, and Trends for the Future. We're going to be talking about kind of where we are with respect to, in particular, kind of provider services. In the future, there's been some bumpy roads, and Max has some thoughts on where that is all headed. But Max, if you could give an introduction of yourself and Cockrell Group before we jump into some questions.
Well, thanks, Geoff. It's great to join you today and very much appreciate it. I've been with Cockrell for about 33 years, and we, in fact, are a result of a fairly recent transaction with private equity ourselves. So I can speak both in terms of helping our many clients, mostly physician practices and related entities on the sales side, as you mentioned, and then our own business too. So I'm honored to be here today and look forward to our discussion.
Max, maybe we could start with your book. What would you describe as the kind of principal thesis of the book?
Yeah, we wanted to write a book, Geoff, that would tell the complete story. As healthcare advisors, which is what we have been at Cockrell for almost 40 years, we don't really take sides, as it were, in terms of private equity, pros or cons. So we really wrote the book intentionally for all perspectives of potential readers. That would be physicians, it would be healthcare executives with health systems, it would be attorneys, it would be other consultants, and indeed private equity firms themselves. So we wrote it, I always say we wrote it with both the pros, the cons, and kind of the good, the bad, and the ugly, you might say, involved, and really just wanted to make it more informational and something that whatever the reader's perspective might be, they could say, well, I got some good information about it. We really stayed away from commentary and this is great or this isn't so great, so to speak, with private equity. Like anything else, there are good points and there are some less than good points with a private equity transaction.
The role of private equity in healthcare has become a bit of a charged topic, as you know, and that partly your book is kind of wading into some of the facts around kind of private equity's role. One of the theses is that private equity naturally, through accumulating market power, is going to put pressure on the cost of healthcare. Do you have a perspective on the degree to which that's true or how prevalent that is, or some kind of counterfactuals on that premise?
Well, I think, you've seen one transaction, you've seen one, and there's a lot of variation in terms of what the future holds post private equity transactions. A lot of it may vary, Geoff, with the specialty that's involved. Some of the more prominent specialties that have resulted are, of course, the dermatology, radiology, pathology. Now we're getting more and more into specialties such as orthopedics, cardiology, et cetera. As far as the cost curve and what all is involved, private equity is no less interested in controlling costs and certainly are concerned about rising cost of healthcare and the delivery of it than anyone else. So I don't think that that is an issue. If we crossed over the line, so to speak, and talked a little bit about profit and profit incentive, there may be some differences there between what we might see with major health systems, particularly those that are for not for profit. But of course, that doesn't mean they're not engaged to make a margin. That is, they're just not for profit based on their charter, as it were. So I don't personally think that cost are any less a factor. If anything, private equity might be argued to say, hey, we're a little more concerned about controlling costs because we are very much incentivized by profitability, increased EBITDA, and that old proverbial second bite of the apple when the recapitalization takes place down the road.
Probably approach it a little differently. I probably land a little bit more that I can see the incentives of private equity investor of increasing reimbursement rates for the services that are provided. Where it starts to break down the analysis that private equity is a bad actor in the whole ecosystem is from the perspective of market power, with kind of few instances where they do have market power. The overwhelming instances, I find that the private equity backed platforms just don't have the kind of market power to be a price giver. And so the idea that they can completely manipulate reimbursement rates, I find to not be exactly true. And if there's actual kind of market concentration, I think it's more likely to be in the hands of, say, a health system in a kind of single health system community, or payers in many places across the country where there's not a lot of competition amongst the payers. I find that those groups actually have market power, and that, to my eye, private equity has done a poor job of kind of defending itself against some of the critiques.
I agree. I think, as I said, and you kind of inferred that, I believe, just now, it's all over the page, and it kind of is based on individual structures. Some private equity firms have greater payer wherewithal, if you want to call it that. And obviously, we are talking about a platform concept where private equity aggregates and builds on the basic platform. And so the more critical mass of practices, the better. And at least in some respects, one would think maybe some market power, market influence would be greater. But really and truly, I don't think that would come up against very effectively, as you indicated, a major health system, for example. I live in Atlanta, and not to get specific, I mean, we have whatever, five, six major health systems here, and they all do incredibly well overall, some better than others. And we'll touch on that, I'm sure, as we get into our discussion a little bit more. But I think where also it kind of comes into play would be what we typically call the ancillary services that come with practices that private equity are extremely interested in adding to that overall portfolio. I'll stop there, but yeah, I think you made some great points.
Some of the kind of private equity backed platforms in provider services have encountered headwinds, whether that is kind of challenges around labor or just raw balance sheet challenges. What do you think the current atmosphere for provider services platforms is right now, as far as kind of overall operational success?
Well, I think a lot of it depends on the ability that a particular private equity firm can come into a geographical region and have successful acquisitions where that platform is stronger and there's more critical mass overall to support their overall business strategy. There's no question that private equity insists upon a margin. Their investors are just that. They're private investors that are putting up their money, their funds, their wherewithal. And so I think there's definitely from day one the need to make successful transactions, acquisitions, and be accretive to that foundation, that platform practice as such. And a lot of that will depend on that initial deal. Now, I don't know for sure if you're referring to kind of the way the deals are structured vis-a-vis the multiples of EBITDA and how they've changed in recent times. We can touch on that if you like, but I think there was a point in time where the multiples and the overall purchase prices were somewhat higher than they are today. And that obviously can have an effect on the return on investment and a lot of other things down the road. And I think we're seeing more and more, we'll call it what you like. Maybe it's stabilization, maybe it's a market correction, as it were. something like that. But I don't think the deals themselves, personally, the ones that we're exposed to and read about and so forth, are quite as lucrative. And perhaps those are the reasons, is because the return hasn't been quite as good over the last 2 or 3 years.
The kind of somewhat declining EBITDA multiples on sale transactions has put kind of pressure at different parts of the market. And one area where I have seen that kind of pressure most pronouncedly is in the kind of the smaller end, meaning like you've got a platform and they're often growing through a series of kind of add-on acquisitions. And I've found that the bid ask on pricing between sellers and buyers has been just too far, that the cost of capital and labor pressures have made the operational profits of some of those platforms more difficult, which all those things add up to likely lower sale prices for add-on acquisitions. But that pill has been a difficult one for kind of the smaller groups to absorb. You see some of that bid-ask pressure subsiding here in 2025?
Oh, well, first of all, I totally agree with you. There's no question that that has occurred, what you just said. As it relates to crystal ball in 2025 and even beyond, I think a lot of it will depend on what you alluded to, the cost of capital and exactly how the deals are coming down. It's becoming just the mere operation of, let's just say it's a medical practice and doesn't really matter what specialty, overhead is increasingly higher, margins are lower, EBITDAs are lower, physician compensation expectations, even with the income scrape et al., are stressed. And so there's a lot of challenges to make the formula work. Now, it's still a very good proposition, and I'm very much pro private equity when it comes to a certain structure and situation. Although I think the expectations relative to returns, ability to recap within a quicker period of time, et cetera, continue to be more and more stressed. So I'm not a pessimist, but I don't see personally a tremendous improvement in 25. Maybe interest rates and inflation will come down with the new administration. Who knows? That could certainly have a positive effect. I don't think we'll see much of it in the deals being made in 25. Now, with that said, there's still a lot of capital out there to be invested. And so that's kind of the other side of the ledger, in my opinion. Cost of capital et al. Is higher, but there's still plenty of funds out there to invest. And while I'm not an expert by any means in other industries that much, I read about them like everyone else. We're strictly healthcare in our practice. I think that healthcare is still one of the best industries for private equity to invest.
What's your sense of the up market? Because you've got all these consolidations. Private equity fund buys a small, mid-size platform, build it up a bit, sell it to a bigger one and a bigger one. Eventually, those platforms become very big. And there's been a lot of question about what the market looks like there. What's your prognosis for some of those kind of big box buyers in healthcare provider services?
I think that consolidation in general, both within that sector, as you alluded to, and just in general, will continue to be very aggressive. I have no crystal ball, but the previous administration was somewhat aggressive in enforcement of antitrust and those sorts of things. And again, you're the expert there, not me as legal counsel, but supposedly that will be lifted. So the ability to aggregate in that manner more and more from a legal regulatory perspective may well be, that box may be lifted or not as stringent. With that said, there's more and more talk among the politicians for more regulations relative to private equity and parameters there. Again, that's pretty early on. So who knows for sure? But I would say that the funds that are very healthily invested in, the private equity funds that have that level of capital, are going to go after more and more acquisitions and will continue to aggregate. And in that respect, I think they'll have a greater market share. Now, going back to their influence on payer rates and reimbursement, I don't know if that will be enough. It certainly wouldn't hurt to have greater numbers, so to speak. We always call it strength in numbers, but we shall see. I wish I wish I had that crystal ball that I could do a little better in prognosticating, but frankly, I don't see a tremendous improvement in 25 at this point.
I'm probably a little bit more optimistic that some of the headwinds will resolve. Rates may not kind of come down dramatically, but the balance sheet kind of challenges around platforms that those rates, and it's not just the rates themselves, it's the degree of leverage at the front end of those deals that is now creating kind of cash flow pinches that has a way, one way or the other, sometimes good, sometimes bad, it has a way of resolving. There's a lot of businesses that within kind of the four corners of the business, if you back out the load of what might be too much debt for that business, if you back that out, it's still a performing business. So those types of issues have a way of resolving. Labor dynamic have a way of getting a little bit better. The kind of the leverage of the labor side of the equation that kind of ebbs and flows, and it feels like that's pulling backwards. So some of those businesses, I think, transact, whether it's for those dynamics or the fact that some of the private equity funds have been in them for a long time and just they need to move on from those investments one way or the other. So I think there's going to be a fair amount of those sorts of transactions that will then kind of open up those businesses to a new day where they might have a little bit better balance sheet. So I'm optimistic there. And I still think there's a fair amount of tailwinds in the sense that scale is going to continue to be important. And I think it's less important in the sense of just like market power, leverage over payers. I think it's more significant in the sense of just the continued ability to kind of internalize revenue streams, whether that's you get to a certain scale and you can do more with ancillary services, you get to a certain scale and you can do more with ASCs, you get to a certain scale and you can do more with value-based contracting. I think all of those kind of tailwinds will continue to press this forward. So I'm a little bit more optimistic than you.
Well, I hope you're right, because I think it would be healthy overall. And we're very heavily involved on working with practices, whether or not they're involved in private equity or not. And so typically when let's say, just to make up a orthopedic practice would come to us, one of the first things we try to do is provide information and education, which quite frankly is one of the reasons we wrote the book, is that. And many times I'll just say, well, here, it's an easy read. Go ahead, and hopefully it helps you understand what's going on a little better and how it's structured. But inevitably, we're faced with the options, the alternatives, such things as, well, maybe we merge with another group and then do a private equity deal. Makes sense, although it takes longer, of course. Maybe we align with a health system, and certainly we do a lot of those and support them greatly, support our good hospitals throughout the country. And then, of course, there is the private equity affiliation directly. And so I think not all, one size does not fit all. There are a lot of dynamics at play that you alluded to, different forms of reimbursement vis-a-vis quality and things like that. And physicians, are always faced with the struggle with the younger versus the older physician, the older physician being much more amicable towards a private equity deal for obvious reasons, the younger one not so much. So a lot of options out there. And really what we try to do, Geoff, is, I'm sure like you, from a legal perspective, is just lay out the facts, the pluses, the minuses, and see where it falls from there. It's very rare that a practice comes to us and knows for sure that they want to do a private equity deal. That's just my experience. Now, I'm sure there are those that have made their mind up, and if so, that's fine. We'll help them. But anyway, we shall see how that all comes together and whether or not that critical mass, in fact, occurs.
One of the dynamics from looking at and talking to a lot of investors, as provider services has become incrementally more difficult place to invest, a lot of pivoting into other kind of healthcare areas. Do you think that's going to continue with move towards pharma services, payer services, other sorts of healthcare related sectors?
I do. I think they're already that's starting. I think we'll see more and more of that. I don't think that there's any necessarily, unless it's a legal or regulatory constraint, there's any particular model or structure that's off the charts or not tenable. It just seems like that is the case. I often am asked kind of a crazy, in a way, kind of a crazy question. Well, how do hospitals and health systems deal with private equity? And I think the answer is it's possible, it's doable. The big area, though, that is, let's just say, not in agreement between health systems and concept of private equity is, of course, in the ancillaries. And you see more and more of the ASCs, imaging centers, et cetera, cath labs that the private practicing physician is interested in investing in and already has in many cases. And they find that private equity has the capital. And of course, private equity is very interested in them. So that's probably the biggest area where I think there's going to be conflict among the providers. And then on top of that, the payers are getting more and more involved in also being providers. So back to my original point of answering this question, there's really no pat answer or pat structure. It's almost, as long as it's legal and ethical, I suppose, it's possible in our healthcare industry, which is kind of why it's so fun to work in it.
Yeah, you can see the convergence of these kind of rivers in a lot of areas. I feel like in a number of sectors, most of the deals that I'm working on are some sort of joint venture apparatus with either a health system or like a large ASC management company, but kind of triangulating around ancillary services and kind of ASC businesses is been a real focus on a lot of them. And those can be super complex, and the lines between a health system and a practice can get thin. The lines between a payer and a provider can get thin. And even we're starting to see kind of convergence around some kind of other participants in healthcare as you see kind of pharma companies being purchasers of large practices with the idea that they are either kind of purchasing through affiliation with a large practice platform. They're kind of picking up distribution of, say, drugs for an oncology type practice. You see that sort of dynamic, or it might be kind of picking up in a large practice the ability to kind of really ramp up clinical trials through those practices. So you see a real kind of convergence from every direction. It's pretty constantly evolving.
Yeah, absolutely. You said it very well. There's really no one that's not a possibility to be involved in those joint ventures et al. It's again, I think it's kind of fun, but we do have to be careful on the regulatory side of things, and that's why we always use great attorneys like y'all to make sure we're within those white lines, as I call it.
With that note, maybe we'll bring this to a close. Max, it's super interesting to talk about kind of current trends and what's going to be coming down the pike. Really appreciate you joining me. It's been a ton of fun.
Well, thank you, Geoff, and I enjoyed it and look forward to learning more as we all go down this road over the next couple of years and then later in the future. It's definitely going to continue to be a lot of great opportunities for really everyone in healthcare in this country and perhaps even internationally too. Who knows? So thanks for having me today. I enjoyed it, and best good fortune to all on the listening on this podcast.
Thank you for joining us on this installment of the Corner Series. To learn more about today's discussion, please email host Geoff Cockrell at gcockrell@McGuireWoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this series, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.